think there's been any major change in positioning for the portfolio over the second half of our financial year. But what we have done over the last few months is actually introduce a couple of new companies into the portfolio, Hiscox and Sage. So we've been looking to take advantage of both new research and changes in prices, which have created some attractive opportunities, both for capital and income investments. I mean, most of the first part of the year was very much dealing with what were quite turbulent markets. We were really very much focused on investing capital into our best ideas. We weren't really looking necessarily for new things, but trying to take advantage of securities that have been sold down in many cases quite significantly. The second half of the year has been a little bit more stable, and I think that's provided the opportunity to look for some new things. So that's probably been the main focus of our efforts and attention. I don't think there's been any major shift in terms of positioning over the second half of the year. So it's really been all about sort of stock selection, adding to specific exposures where we see good opportunities. But I wouldn't say the overall portfolio in any particular way has shifted. Well, the second half of the year, I think we're broadly flat against a market which was up a little bit. So again, I think it's been a year of contrast. The first part of the year was pretty difficult. The second quarter was pretty good. Again, we struggled a little bit in the third quarter, came back quite strongly during parts of the fourth quarter, and then lagged a little bit in January at the final month in the year. I think overall, given our sustainable overlay, that means that we can't invest in some of the areas which have been incredibly strong performers in 2022. I actually think the performance of the trust overall has been reasonably creditable. We've lagged a number of our peers, but then we can't have significant exposure to oil, mining, defence, tobacco, some of these areas that have actually proved to be very, very strong investments over the last 12 months. So I think against that backdrop, we think we've done okay. It's not been great, but we think the performance has been okay. Certainly on the income side, we've had a pretty good year from an income generation perspective. So we're yet to get our sort of year-end results completely locked down, but we think that overall the income performance has been pretty creditable as well. So I think it's that combination of robust absolute returns, lagging a little bit relatively, decent income performance against the backdrop that's not been particularly helpful for us from a stylistic perspective. I think overall we'd say that that's an okay outturn. And then when we look out over the longer term, over the sort of 5-year period, the trust performance in versus its peers and versus the market remains relatively robust. And again, as we move through into 2023, hopefully that's going to present some good opportunities, and perhaps a market that might be a little bit more balanced and might open up a little bit more potential for stock pickers and having a little less driven by the big macro gyrations that we've seen over the course of 22 and 21. Yeah, so I think one of the big things that we did just sort of coming into the half year and into the start of the second half of the year was to build up a big position in Unilever. And that's a company that had rather fallen out of favour. I think luminaries like Terry Smith were saying that it should just focus on selling mayonnaise, and we wouldn't disagree with that. But we felt earlier in the year that the valuation had come down to a very, very low level. The dividend yield was well over 4%. It was probably trading on 12 or 13 times earnings. And you don't often get the opportunity to buy a business like Unilever on those sorts of valuation multiples unless there's something going wrong. But the business has, I think, returned to some degree of form in the second half of the year. The valuation has re-rated somewhat. And actually, some of the advantages of Unilever's business' exposure to emerging markets have started to come to the fore. And so we think that's been quite an interesting thing to build up in a contrarian way over the course of the year. We've also, I think, stuck to our guns in terms of our financial positioning. That's been a part of our overall positioning that's been sort of tough in parts over the course of 2022, but we've started to see some of those stocks perform better over the last part of the year, particularly something like Prudential, which has really benefited from the opening up of China following the release of the COVID restrictions and potentially the relaxation of restrictions with the Hong Kong-China border. So we think that's well positioned. Again, a stock that trades on a relatively low valuation relative to its history, and we think that's got good growth potential and also re-rating opportunity ahead of it. And then I think we've also been looking to add a little bit more to some of the domestic plays. Again, as we saw with the Liz Truss Kwasi Kwarteng budget in the autumn, that caused a big sell-off in UK assets, a lot of concerns about the domestic picture, big slide in sterling, big spike in bond yields. And we actually thought that presented quite an interesting opportunity to add modestly, but indeed add to our positions in the house builders, in some of our construction positions as well. So a company like Taylor Wimpey we added to. We also increased our holding in Marshalls and Morgan Sindall as well over that period. So again, looking to take a little bit of advantage of a situation where the domestic picture was looking beaten up and oversold. So I think that's really been the tale of the year, trying to hang into some positions that have been tough, looking to take advantage of market dynamics moving in our favor, I guess, presenting some interesting opportunities where things have fallen out of favor, where valuations and potential returns look attractive. And then, as I say, as we move through the second part of the year, particularly into the final quarter, we've also taken the opportunity to add a few new names to the portfolio. So we've added Hiscox, we've added Sage, we've started a position in Oxford Instruments as well. So we've been quite active in that regard in the last part of the year. And overall, we continue to think the portfolio looks quite well balanced, capable of performing in a relatively wide range of environments. And we're not heavily dependent on any one particular outcome. And while it's been a headwind in 2022 to not have huge gearing into interest rates going up or into commodity prices, I actually think over the medium to long term, that's really no bad thing. Those things are somewhat out of our control. They're not particularly predictable. If they're playing in your favor, that's great to have. But actually, we haven't particularly benefited from that this year. But equally, that's not something that could move away from us in future periods either. And it's really coming back, looking to find those companies which can grow, primarily driven by structural growth. There's always an element of cyclicality, but where we can find companies that have got strong structural drivers that can drive revenues, drive profits, drive cash flow, and ultimately drive dividends. And that's really what we're looking for in a focused but sensibly diversified portfolio. And I think we're in a pretty good position looking forward into 2023 as a result. Well, we have a fairly idiosyncratic stock within the portfolio, Games Workshop. As some of you may know that, you may have seen their shops on high streets around the UK. But it's a business that sells into the modelling, into the habit market, the little Warhammer figures. It makes tremendous margins. It's expanding internationally. It sells into Australia, sells into the United States, increasingly selling into emerging markets. And it's a business where that hobbying market is growing very, very nicely. And the thing that's really been quite exciting recently is potentially signing up content deals with the likes of Amazon, which is going to allow them to generate really high margin license revenue from movies, potentially from TV series as well, and also all sorts of other forms of digital content. So Games Workshop, it's a stock we've owned in the portfolio for about the last 3 years. It's really wonderful investment for us. It's generated significant growth in dividends. It's been a very, very strong performer in terms of the capital which we've got out of that investment. And it's a stock which flies somewhat under the radar, but which is really driven by that demand for hobbies, for collecting, which remains very strong in a market that's underpenetrated and where they have a really, really strong franchise and the potential to branch out, not just geographically, but also to enhance their penetration of existing markets and to sell increasingly in a digital format. We think really underpins that business for the long term. And it's always had a policy of distributing any of its spare cash in the form of dividends, which again is very helpful for our revenue accounts. So Games Workshop's been a really interesting little investment for us, and it's been something that's worked out very well over the last 3 years. And I think indicative of the fact that we're prepared to invest in companies that wouldn't necessarily tick the income box, but it's our focus on both generating yield today and growth tomorrow that can put us in a good position. Another company that I'd pull out perhaps at the other end of the spectrum would be something like Taylor Wimpey. It's a business in the UK house building sector. Again, a sector that's been significantly out of favour over the last 18 to 24 months. It's been hit by the increase in bond yields, a slowdown in demand for mortgages, the debacle that we saw in the autumn from the Truss and Kwarteng budget, and also been under pressure from some of the regulatory changes that the government's been putting in place in the wake of the Grenfell fire as well. So it's had a number of headwinds. But by the time we'd got through into September, October, the stock was trading at the same level in terms of price to book that it was in the financial crisis. Yet it has, I think, 600 to 700 million pounds of net cash on its balance sheet, a market cap of about 3.5 billion at the time, and trading on a very high yield, again, looking to pay out most of its spare cash in the form of dividends. And we really think that looks too cheap. We thought it looked too cheap then, and while the stock's recovered, we still think it looks too cheap now. And that's a business that's, I think, dialed into some relatively decent longer-term trends. The demand for housing is likely to remain strong. Supply remains relatively constrained. We will see mortgage availability recover, and ultimately it's all really about volumes over the medium term, particularly as we start to see some of the cost inputs that they've been facing fall away. And that's a business which we think will generate lots of cash, pay quite a lot of it back to us in the form of dividends, and then at the same time opens up the perspective of a good re-rating in the stock back to a more normal price-to-book ratio as well. So perhaps one at the other end of the spectrum from Games Workshop. It's certainly not an IP-light, high-margin, fast-growth business, but it's a business which we think can grow quite nicely and which will actually generate some really attractive returns for us as well. So at both ends of the portfolio, income growth and then that higher-yielding income stock combined, I think, together make quite an interesting combination for the portfolio overall. Well, I think one of the big things for the trust is its focus on sustainability. That's been something that's been out of favour over the last 18 to 24 months. And as we know, investors are a fickle bunch. As soon as you start to see tobacco, armaments companies, oil and gas, coal stocks doing well, they start to suck their teeth and say, well, is it possible to invest in these companies? Maybe they're not too bad. Maybe they're not really as bad for the environment or society as we thought before, because actually there's the opportunity to make some returns on the near term. And actually, isn't it all about engagement and helping to make these companies better? And that's a perfectly respectable position. But Dunedin has set out its stall that it doesn't want to invest in those businesses because it thinks over the medium to long term that their models will be compromised and ultimately will deliver poor returns to investors. Now, certainly 2022 has been a year where anything but that has happened. But we do believe that as we move forward from here, investors are going to start to focus back on their requirement to invest sustainably. We believe that the end investor is only going to want more of that. We think regulation is going to move in that direction as well. And we fundamentally believe that companies that do the right things in their businesses will ultimately be able to grow at attractive rates over the longer term as well. And that's what's going to fire dividends, it's going to fire cash flow, it's going to fire profits as well. And those things are all going to be absolutely critical to delivering that total return. And so sustainability has very much been one of those things that I think has gone off investors' radar. I think they're bored of ESG, they're not really that interested in it. But I think if anything, it's going to come back with a vengeance over 23 and beyond. And we believe that Digit's very well positioned to be able to take advantage both of potential opportunities within the market, but also to provide a home to investors' capital within the UK income growth space, which again doesn't have a lot of scope for investors who want to invest away from stocks perhaps in the resource intensive area or those in other areas that we would consider to perhaps not be sustainable over the longer term. And so we think we're pretty well positioned for that, and we expect to see investor interest sort of refocus on that as we move through the year.